Guido, for the kind introduction. It's quite correct to say that I have an unusual background for this audience, at least. And I feel not quite competent actually to present in front of this audience, but I'll try to do my best, and inevitably my presentation will come from a regulatory or legal background. But the research project that I'm going to present is genuinely interdisciplinary, and I think just a couple of words on the background to this project. So what I've done so far, and the paper that I'm going to present here, could be seen as something like a scoping exercise. So I just set out the regulatory framework, and then I assess in that paper whether, in my opinion, the regulatory framework works well. I think it doesn't. I think there's in general a pretty clear lack in understanding fully the theoretical underpinnings of the regulatory questions that the policymakers address. So there's a lot of work, I believe, to be done. So that's the purpose of the paper as it currently stands, is to identify these shortcomings in the regulatory framework. But I'm afraid to say that I don't really present any answers or any solutions. And the reason for that is that to develop solutions is simply outside my competence. So in order to do that, in order to take the research agenda forward, I think it's essential to connect to people like you with your expertise and your background. And that's why I'm very grateful that Guido organized this seminar. I'm also very grateful that the last seminar speaker, Gerardo Ferrara, is here, and also Roberto Reno and Maria Flora, who have written a couple of papers which are very much relevant to what I'm going to talk about. And it would be great to get some conversation started on how maybe to integrate the regulatory agenda and the findings that come from your research. So thank you very much for making the time to attend my talk. I really appreciate it. Let me start with a couple of really quite obvious points. I don't want to spend too much time on them because you're all much more familiar with that than me. As you know, algorithmic high frequency trading has become pervasive and very important. It now accounts for a significant fraction of all trade on markets, depending a little bit on the precise marketplace and on the market segment. Algorithmic high frequency trading accounts for estimates are between 40 and 80% of trading volume. And flash crash-like market incidents have also become increasingly common over the last decade or decade and a half or so. So the algorithmic trading and high frequency trading as such, and specifically flash crashes, have received increased attention from policymakers and regulators. And we find in most jurisdictions now certain regulatory approaches to responding to incidents such as flash crashes. I'm going to talk a little bit about what the regulatory framework currently is, and then offer some critical views on whether it works. The main piece of regulation in the EU is the Market in Financial Infrastructure, Market in Financial Instruments Directive, now in its second installment, so MiFID II. And in the United States, the main piece of legislation is called Regulation NMS. NMS stands for National Market Systems. That has been adopted under the authority of the Securities and Exchange Act of 1934. But there is, as I said, I think, fairly weak theoretical empirical grounding of these regulatory mechanisms. And I think there are three main challenges to regulation that are posed by automated trading in modern financial markets, both algorithmic trading and also high frequency trading. And these three main challenges, as I see it, are, first of all, that effective systems are in place in order to test and monitor the performance of algorithms in order to ensure that algorithms perform as anticipated. Secondly, regulators face the challenge of identifying if and when algorithmic trading gives rise to volatility, to increased volatility in comparison to manual trading, and then also to identify whether this increased volatility is harmful, so whether it is a sign of market inefficiencies and hence a case for regulatory intervention can be made here. And the third challenge is that regulation should ideally be coordinated across markets, across exchanges, marketplaces, and also across market segments, because trading, of course, very much takes place across markets. That is the case in the EU very much. It's also the case in the United States. If you look at the regulatory framework in the US, there is, I think, a fairly high degree of coordination, because the stock exchanges are co-opted by the policymaker in order to develop certain regulatory frameworks that then apply to all national stock exchanges in the United States. These are so-called national market system plans. But coordination is much less developed in the European Union, also between the EU and the UK or other non-EU marketplaces in Europe, and that potentially also gives rise to problems. So these are what I think the three main challenges that a regulator currently faces. I'm going to talk about the first two in some detail. I will touch upon the third one in passing, but just very briefly in the interest of time. So coming to the first challenge, testing and monitoring systems. I start with a brief sketch, a brief overview of what regulation currently says, and then I will offer some critical views on these regulatory mechanisms. So as I said, the main piece of legislation or regulation in the EU is MiFID II, and the key provision in MiFID II concerning the internal control systems that an investment firm must have in place. The key provision is the one that you see here on the upper part of the slide. MiFID II provides that investment firms that engage in algorithmic trading must have in place effective systems and risk controls to ensure that its trading systems are resilient and have sufficient capacity, are subject to appropriate trading thresholds and limits, and prevent the sending of erroneous orders or the system otherwise functioning in a way that may create or contribute to a disorderly market. So a very general provision that has been implemented in more detail in an implementing regulation, a MiFID II level 2 regulation. That's the usual regulatory approach in the EU, that you have a framework directive or regulation, in this case MiFID II, and then a number of implementing regulatory mechanisms. And the MiFID II level 2 regulation sets out in more detail how the internal compliance function must be structured, so that investment firms, first of all, must have an internal compliance structure, how it must be structured, that there must be clear accountability, clear reporting channels, etc. There must be environment and the compliance function and the production environment, for example, etc. The regulation also requires that investment firms must have systems in place in order to test algorithms before they are deployed in the live market, and to monitor in real time their performance. And investment firms can either develop their own simulated market environment in order to test algorithms, or they can use, for example, a simulated market environment provided by stock exchanges. The regulation also requires them to provide for certain stress testing, so certain episodes of particularly high order flow, for example. And then need to be certain safeguards, so thresholds and limits, for example, a kill functionality that allows the investment firm to stop the execution of an algorithm. And the execution of algorithms must be subject to certain order volume limits or number of orders limits. And finally, there need to be there are record keeping obligations, and these transaction records must, in certain circumstances, be disclosed to the regulator. There's much more. This is, of course, laid down in much more detail in the regulation, but I think as a broad overview, that shall suffice for now. You have very similar requirements, regulatory requirements in the United States. That's the so-called, they are summarized under the so-called market access rule. And to those of you who are inclined to look more closely into the regulatory framework, I've given you a reference to the relevant legal mechanisms in the United States. Yeah. Now, a couple of points on whether this approach is, in my view, effective. What the regulation in general, of course, to have a compliance function, to have a testing environment, to monitor the execution of algorithms, that all, of course, is sensible. It allows the testing certainly of individual algorithms, and the regulator also tries to provide for an environment where the interaction of algorithms can be tested to some extent, at least. But I'll say a few more words about that in a moment. If investment firms do not comply with these requirements, then in principle, sanctions can be imposed. The SEC is in general more vigilant in the enforcement of these requirements. The largest, as far as I know, the largest penalty that has been imposed for violation of the market access rules, so for violation of the requirements concerning the internal risk and compliance control functions, the largest fine that has been imposed was a fine in 2016 that was given to Merrill Lynch, $12.5 million. There is comparatively less enforcement in Europe, both in the UK and also in continental Europe. The FCA is generally also, at least has become now more vigilant and has been more rigorous in the enforcement of the regulatory framework. In continental Europe, depending on the economy you look at, there can be very little enforcement activity. So the first question you might want to ask is whether these regulatory requirements are actually complied with in practice. The second point that I would like to make, and that is a conceptually more important point, I think, is that the question is to what extent these provisions that the policymaker makes can ensure that there is an effective testing of how algorithms operate in the live market. And the key point here, I think, is that a simulated environment will need to make some provision for simulating the interaction of a variety of algorithms that will interact in the real market. In many cases, the reason for a flash crash, that at least is the common view, such as the famous flash crash of 2010, which I think which we also referred to in the last seminar. In many cases, the reason for a flash crash is that algorithms interact in a way that gives rise to harmful feedback loops. And I think that it is fairly well established that was the reason why the flash crash of 2010 happened. Just very briefly on this point, in that flash crash, a fundamental trader, Waddell and Reed, exercised. I'm sure you will be much more familiar with that than me, but just to corroborate the point that I'm going to make. A fundamental trader, Waddell and Reed, executed a percentage of volume algorithm in order to divest of a large position. And so a percentage of volume algorithm is that can be programmed in a very simple way. Basically, the volume of each child order that is executed by the trader, by trader I, at a particular point in time t, is calculated as a percentage of the total volume traded in the previous period. That's how the Waddell and Reed algorithm was coded. In that case, P equaled 9%. So each child order the size of each child order was 9% of the total volume traded in the E-mini securities in the previous period. I've come across some statements, some assessments of the flash crash that argue that recursive programming of the POV algorithm in itself created distortions in the market. But I think that's a POV algorithm programmed in this way in itself doesn't pose any problems, because the size of child orders after T intervals will very quickly settle. So the marginal increase in volume of that is contributed by each child order decreases exponentially, and that will happen very quickly if you take the waddle and read POV algorithm, which, as I said, had a participation rate of 9%. Then after 3 or 4 child orders, there will no longer be an exponential increase in the size of child orders. So the algorithm itself, whether the algorithm itself operates effectively, can be assessed very easily, but that doesn't mean that the algorithm does not create harmful feedback loops, and that seems to have happened in the case of the 2010 flash crash. That's at least what the CFTC and the SEC concluded in the report that they published after the flash crash event. They argued, that's just one paragraph, one quote from the report. They argued that the sufficient demand was lacking for the sell orders of Waddell and Reed from fundamental buyers or cross-market arbitrageurs, and the market makers, the high-frequency traders, began to quickly buy and then resell contracts to each other, generating a hot potato volume effect as the same positions were rapidly passed back and forth. So the sell orders were not absorbed by the market, but there was an increased pressure on the sell side of the order book, and that then created, that's what CFTC and SEC conclude, that's created a significant downward pressure on prices. So the question is how the regulatory environment can identify such specific interactions between algorithms. And I think the current regulatory setup doesn't necessarily guarantee that such harmful feedback loops will be identified. As I said, there needs to be a testing environment at the level of the investment firm. That is mandatory under MiFID II. But the investment firm itself will only be able to test interactions with standard algorithms. At the level of the marketplace, that it will be more likely that a variety of different interaction effects can be tested, and potentially harmful interaction effects can be identified. But first of all, it's not mandatory to test at the level of the marketplace. It's possible. The London Stock Exchange, for example, provides a testing environment. It's customer development service. It's not mandatory, however, under the regulations. And the second question is whether indeed harmful feedback loops will necessarily be identified. I do not think, I don't think that they will necessarily be identified. It depends very much on the algorithms that are deployed at any point in time in the testing environment. So the question is whether regulation can do more here. A question that has been discussed is whether the actual codes should be disclosed to the regulator, and the regulator can then test the different algorithms that will be deployed in the live market in a testing environment provided by the regulator. So currently, there is no such requirement either in MiFID II or in the United States. I'm not aware of any such requirement anywhere in any jurisdiction. It's maybe unsurprising that there is no mandatory requirement, because investment firms will resist any form of disclosure obligation of the actual code, even if it is only to the regulator, and the regulator would be under a duty of confidentiality here. But that will be likely strenuously resisted. It's also a question whether it is feasible to have a testing environment provided by the regulator. And I would be interested in your views on that, whether regulation should go down that route, and whether a regulator has the necessary resources and the necessary infrastructure in order to test the interaction of potentially very large number of algorithms. And furthermore, we should also consider that algorithms may be programmed so that they evolve and learn as they operate in the live market. So another question is whether it makes sense at all to have such a testing environment if the live market, if the simulated market environment still will not replicate exactly how algorithms operate in the live market. I'm not sure what the answer is, and I think you will probably be better placed to offer some views on that. Currently, as I said, the position of regulators seems to be, and policymakers, that such a requirement should not be imposed. It was discussed in the UK, and the UK policymakers concluded that because of feasibility constraints, it's probably unlikely that such a requirement would provide for an effective way to test interaction effects. But that leaves us with the question, well, how can they be tested effectively? So that's the first challenge, and these are the first set of questions I think that policymakers grapple with and that they haven't answered satisfactorily yet. The second challenge I want to discuss in some details is how volatility, harmful volatility, so volatility that is indicative of inefficiencies in the market, frictions in the market, can be identified and curbed. I start again with the main regulatory mechanisms that are in place in the EU. MiFID II provides that trading must be halted if there is, so there must be a circuit breaker, if there is a significant price movement in a financial instrument. That's all that MiFID II says. It doesn't specify what, for example, a significant price movement is, or how in other ways the circuit breaker should be calibrated. ESMA provides for certain common standards that stock exchanges, marketplaces need to take into account in calibrating their circuit breaker in order to ensure the consistent application of this provision in MiFID II. And the relevant criteria are, among others, that ESMA requires marketplaces to have both a static and a dynamic reference price in place, and that the trigger thresholds should be calibrated according to the nature and liquidity profile of the financial instruments. So tighter parameters, for example, should be applied to more liquid instruments, and also according to the trading mode. Otherwise, the precise calibration of circuit breakers is left in the discretion of the trading venue in the EU. It's different in the United States, as I mentioned, but in the EU, there is accordingly very limited coordination. And so you can easily identify cases where marketplaces may react differently to volatility concerning this one and the same instrument. This is an example from a hypothetical example that is intended to illustrate how the trigger thresholds on the London Stock Exchange and Euronext operate differently and may lead to different outcomes for the same financial instrument. This example is based on a dual listed share, Just Eat Takeaway, which is listed both on the London Stock Exchange. It's part of the FTSE 100, and it's also listed in Amsterdam, on Euronext Amsterdam. The trigger thresholds, so the volatility bands on both stock exchanges, are defined differently for the same type of instruments. So liquid instruments such as Just Eat. On the London Stock Exchange, the dynamic range, so that's a range that is defined around the last executed transaction, the price at which the last transaction was executed. The dynamic range around Euronext is plus and minus 3%, and the dynamic range at the London Stock Exchange is plus and minus 5% for a security such as Just Eat Takeaway, so a liquid security. And the static range at Euronext again is narrower. It is plus minus 8%. The static range is calculated with reference to the last auction price. So either the opening auction or if there's a midday auction, it's calculated according to that last reference, to that last price. And on the London Stock Exchange, the range is plus and minus 10%. So you can have a number of scenarios where the two circuit breakers operate differently. These are three examples here on the slide. The first one is where a bid comes in at a price that exceeds the dynamic range, the dynamic volatility band on Euronext, but not on the London Stock Exchange. In that case, the Euronext Stock Exchange rules provide that the bid, this particular bid, is rejected if it is not specifically confirmed, but trading continues. Trading remains continuous, so there's no circuit breaker, but the bid is rejected. That doesn't happen on the London Stock Exchange. The second example, bid number 2 here, there the bid exceeds the dynamic range, the dynamic volatility bands, both on Euronext and on the London Stock Exchange. It's within the static range at the London Stock Exchange, at Euronext, which is 8%, and it's also within the it exceeds the static range on Euronext, but it's within the static range. No, I can't read my slide anymore. It's within the static range of both Euronext and the London Stock Exchange. This is the threshold for Euronext, and this the static threshold for the London Stock Exchange. So it's within the static range. That means for Euronext, the bid, there is again no trading halt, but it exceeds the dynamic range. So again, the bid is rejected, not confirmed. On the London Stock Exchange, a circuit breaker is now triggered, because the trigger for a circuit breaker on the London Stock Exchange is defined with reference to both the static and the dynamic range. So the dynamic threshold is exceeded. And finally, bid 3. Now we have a bid that is within the dynamic range on both stock exchanges, but it exceeds the static range on Euronext, and it is within the static range on the London Stock Exchange. So there is no trading halt on the London Stock Exchange, but there is a trading halt on Euronext. So in all 3 cases, there are different consequences because of the different calibration of the circuit breaker on the 2 marketplaces. That doesn't mean, of course, that this is an inefficient outcome, as that this is inefficient regulation. But it would need to be discussed whether it makes sense to calibrate circuit breakers consistently across marketplaces, or whether potentially there is some positive effect in having different circuit breakers. The argument has been made in the empirical literature that the trigger of a circuit breaker leads to actually the anticipation of volatility, for example, because market participants, as they anticipate that the price of financial instruments approaches a trigger threshold, so as they anticipate that a circuit breaker will be triggered, they anticipate trades. So if the existence of circuit breakers might actually increase volatility in a range where the market price of an instrument approaches the trigger threshold. And that that could be avoided if the trade can still be executed at a different marketplace where the circuit breaker is calibrated differently. So there would need to be a careful analysis of whether coordination is actually useful, coordination as we have it in the United States, or whether it might have harmful consequences. And the different regulatory setup in the United States and in the EU is a good natural experiment, I think, in order to compare what are the consequences of coordination and the lack thereof. But to my knowledge, there hasn't yet been any comparative empirical study on this point. So that's the first question, I think, that needs to be explored further, what we should do about coordination. I want to talk a bit more also about the definition of the trigger point, so the relevant thresholds under which a circuit breaker is activated. And I want to briefly refer to some general considerations here on the effectiveness and the efficiency of circuit breakers. The general argument is the so-called cooling off hypothesis, that circuit breakers contribute to price stability and the efficiency of price formation because they curb overreaction, so they respond to market friction, to inefficiencies in the market, and they also dissuade market manipulation. But whether that's really, in general, the effect of circuit breakers is quite controversially debated. And I think, as far as I see the empirical literature, the predominant findings are probably that circuit breakers on the whole disrupt the market more than they remedy market disruptions. They, as I said, they might have the effect that volatility is anticipated, or volatility spills over into secondary markets. That point has, for example, been made by Subramaniam in an article in the journal Finance in 1994 already. And that's, I think, the most important point. Circuit breakers also, in my opinion, do not distinguish very well between instances of volatility that can be traced back to market inefficiencies or market friction, and instances of volatility that are simply a function of a change in the fundamentals. In the latter case, trading clearly should not be halted, because to have a volatility jump, or to have a price jump at least, to have a price jump that allows the price to adjust quickly to the new fundamentals, of course, is important in order to ensure that markets operate efficiently. So circuit breakers that halt trading in such a case would delay price discovery. They would, of course, not delay price discovery, but an intervention in the form of a trading halt might be useful where volatility is transitory. So it's not a reaction to a change in fundamentals. So the challenge, I think, here for policymakers is to calibrate circuit breakers in a way that they distinguish, that the trigger parameters distinguish between fundamental and transitory volatility. The question is whether that is possible, and if so, what a good proxy might be for transitory volatility that a circuit breaker might be able to pick up. Since my paper deals with algorithmic trading in particular, and not generally with circuit breakers, I would also be interested in exploring the question more in whether and how algorithmic trading specifically can contribute to transitory volatility. And I think there are two ways how automated trading can do that. But please let me know what your thoughts are. I don't think my views are fully fleshed out here. The first is interaction effects, as discussed before. If algorithms interact in a way as they did, for example, in the flash crash of 2010, then that ensuing volatility clearly is not representative of a change in fundamentals. And then I think Also, the simple speed of execution can lead to transitory volatility because it can lead to liquidity constraints. And I have a couple of points on that, but that is very much outside my comfort zone. So I would again value very much any thoughts that you might have on this point. There is, as far as I know, there is no widely accepted theoretical framework that would model how liquidity is provided in the context of automated trading, and when liquidity provision might dry up, for example. There is an empirical regularity that has been observed in a number of empirical papers in different contexts concerning different markets and concerning different financial instruments, and that's the square root impact law, which provides, you have it here on the slide in the simple form, which provides that the price impact I of an order or a meta order, in the case where you have an algorithm that for example, is used to divest of a large position. So the square root impact law provides that the price impact of an order or a meta order is a function of volatility over the time period t, where over which the meta order is executed, times the ratio of the total size of the meta order to the total volume that is contemporaneously traded, to the power of a parameter delta, which has been found in empirical studies fairly consistently to be around 0.5, hence the name square root impact law. So that relationship has been found, as I said, in a number of different empirical studies in different contexts. It has also been, empirical studies have also made the point that this impact law holds only if Q, so the total size of the order, of the meta order, is significantly smaller than the contemporaneously traded volume. About the point has been made, the observation has been made that Q should not be more than 10% of the total contemporaneously traded volume in order for this square root impact law to hold. So as long as the square root impact law holds, so for example, for a delta of 0.5, the price impact settles down to an equilibrium. And the question may be asked whether regulatory intervention is warranted if that is the case. Some empirical studies have also made the point that delta might actually be less than 0.5, depending on the tick size, for example, of the financial instrument, and also whether we are talking about a meta order or a single order. In the case of a single order, delta is actually less than 0.5. So so again, in that case, the price impact will settle down to equilibrium. It is different if the condition Q significantly smaller than the contemporaneously traded volume V does not hold. In that case, we might have an explosion of the price impact. So the function might actually become convex and is no longer concave. So that I would think can give some guidance to policymakers who wish to calibrate circuit breakers, namely that we should look at price movements that exhibit this convexity in the impact function. So if that's a summary of what I just said, if the square root law holds, it's questionable whether there is a case for regulatory intervention, unless we can identify interaction effects, such as in the flash crash of 2010, probably. If it doesn't hold, then the argument can be made that the increased volatility is a function not of of any change in fundamentals, but it's simply a function of the available volume in the order book being depleted. And in particular, this might happen if Q is no longer significantly smaller than V, if a meta order is executed rapidly. That was another point that the CFTC and SEC report on the flash crash of 2010 made, that Waddell and Reed did not only execute a particularly large order, divided up into a number of child orders, but it executed the child orders rapidly, unusually quickly. So in that case, Q significantly smaller than V might no longer hold, because and we have a convex impact function, because the order book is not given sufficient time to refill. So again, that doesn't have anything to do with fundamental volatility, and we might argue that there a case for regulatory intervention is warranted. The key question, of course, is how to identify such price movements. And I was particularly excited to read Roberto's and Maria's paper, because I think they do that actually. So it was very fortuitous that Guido actually alerted me to Gerardo Ferrara's talk, the last seminar, and which in turn alerted me to that, or directed my attention to that paper. So there are a number of, in the literature, a number of suggestions have been made how to calibrate circuit breakers. The first one is to just look at price jumps, and that's what currently regulation does. I gave you a quote from MiFID. It simply looks at price jumps, and that's probably the least useful way to calibrate circuit breakers, because there's no way in that case to distinguish between fundamental and transitory volatility. Some suggestions have been made in the literature that volatility jumps are indicative of transitory volatility and of market inefficiencies. Others have Easley, Lopez de Prado, and O'Hara look at order flow, and they've developed what they call a VPIN toxicity metric that uses order flow in order to identify the likelihood that this order flow will lead to a flash crash. And then Maria and Roberto propose their V statistic, which I think in principle is exactly the right approach in order to identify the cases where the impact function is no longer concave but becomes convex, because they look at price drift, as we discussed in the last seminar. But I'm still having some I'm still struggling I'm still struggling to translate that into the regulatory sphere and into an actual calibration of circuit breakers. So this is one of the models from Roberto Maria's paper, which we already saw in the last seminar. So we can pick up where we stopped, I think, in the last seminar, because I'm going to stop here with this slide. If I understand your V statistic correctly, then your null hypothesis is that there is explosion in the price drift, possibly before a particular point in time, which you call, I think, tau drift burst, or after that point, or there's no explosion at all. And your alternative hypothesis is that there's explosion before and after. And your V statistic identifies then then helps us to distinguish between these two hypotheses. If that's correct, then I'm not sure that would be useful for a circuit breaker, because it would only allow us to identify inefficient market movements after the fact. When if we look at the first part of your figure, at the upper panel, which traces the expected price. So the circuit breaker could only kick in once the market started to correct itself. And then it's no longer necessary, and it would actually be harmful to halt trading. The statistic you develop in your other paper, Roberto, in the earlier paper, the drift burst hypothesis, which I also had to look at, might be more helpful here, but I would be very interested in hearing what you actually think about that. So I will leave it at that because I've talked really for long enough and I want to leave some time for discussion. Thanks very much for your attention and thank you again for giving me the opportunity to present these ideas.
Yes, Carsten, thank you very much. It's difficult to clap online, and I'm looking forward to the discussion.
I have a bunch of questions, but of course, I will wait for other people to ask questions first. If there are none, I can start.
I had a question. I am Ewan, computational finance MSc student. I was wondering what work had been done on the counterfactual that if these algorithmic traders weren't there. So, first of all, I think it's probably important to distinguish between directional algorithmic trading, where someone designs a algorithm which tries to pick up a signal and have a view, rather than electronic market making, which tends to be what high frequency trading is, which tends to add liquidity to the market. So in the 2010 example, where there was this hot potato effect, what would have happened? What's the counterfactual? What would have happened if they weren't there? You've got Waddle and Reed trying to dump 4 billion of S&P futures onto the market. And clearly the market couldn't absorb that. So if you then take away the guys that are providing the liquidity, and would that not just exacerbate the effect? I mean, if they were buying it and selling it to each other, would that not have slowed the crash, rather than if they weren't there, we could have been down 50% rather than 10% or whatever it was in 5 minutes?
Yeah, thanks. That's a good point. I don't think there have been any simulations also that assess the counterfactual. At least the CFTC SEC report doesn't look at the counterfactual. I don't know if there are any papers that try to model that without the high frequency traders. The problem, I think, with the 2010 event was that the securities were resold, the financial instruments were resold by the market makers after a short period of time, because they probably that's how their algorithms were programmed in order to limit their exposure on one side of the order book. So they were resold quickly, and that exacerbated the pressure on the sell side. So I'm not sure if you have a few fundamental traders that would step in, but only at very low prices in order to make that attractive for them. But they don't resell. I'm not sure that would have actually exacerbated the price effect. But that's just my intuition. I don't know whether there is an actual modeling of that.
But if there were no bids otherwise,
yeah,
it just seems that you can, at least with those guys, at every tick, they're buying and they might sell again instantly, but you're kind of slowly going down tick by tick. Whereas if they weren't there, you would have a situation where you're going to go down multiple ticks at a time because there's no buyers and sellers.
Yeah, that's right. You would potentially need to go down right away. You would need to have a big jump right away in order to find a buyer. So you might end up at the same place or even lower. I don't know, but you wouldn't have that hot potato effect, which might have been self-reinforcing because they continue to sell and other market makers bought and then resold right away again. But I think it would make sense to model that properly, or have a simulation that would assess these these two market alternatives against each other to see what is more useful, or what is less disruptive. But the regulatory question remains whether there should be intervention, or how can we identify a case where there should be intervention in time in order to prevent significant market disruption.
Thank you. So next question, please.
Can I go for it, Guido?
Yes, of course.
So if I may chip in just like one piece of information, one question. So actually about the flash crash idea, what you were talking about, so I'm actually writing a paper in relation to that. And there is some literature essentially simulating and kind of showing that if you reduce the number of HFTs and or the size of the order of 2010 and things like that, it actually seems to be that either or both together kind of actually reduce the impact of the crash. So it seems to be to an extent that perhaps that kind of helps. But kind of on a higher level question, do you think it's because of kind of HFTs existing, or when you describe the execution algo, it essentially looks at the volume that's being traded, right? But that's a relatively naive way to look at liquidity in the market or things of the sort. So could it be, rather than HFTs being in the market, the fact that other players are executing directly, whereby maybe they're not sophisticated enough to really account for what liquidity is in the market and how they should optimize their execution and perhaps hold for it?
Yes. So you're saying your question is whether the POV algorithm was too simplistic, and it could have been avoided if it was calibrated in a more sophisticated
way. Perhaps that's just saying, but that's a very naive perhaps way of looking at liquidity. And if they had looked at liquidity a bit more properly in terms of a lot of other factors, then maybe they simply, because they exacerbated it a lot by keep executing it and seeing a lot of volume, right?
Yeah, sure, undoubtedly, and it's a bit puzzling why they used such an algorithm and not a more sophisticated algorithm, because they were sophisticated, or they are a sophisticated market player, of course. And then it's also puzzling if they use such an algorithm, where I think arguably it could be foreseen that it is vulnerable, since there are no limits, and the algorithm simply looks at the previously traded volume. Such an algorithm is vulnerable to changes in the volume coming from other market players. So Waddle and Reed doesn't have proper safeguards in place, and so it's I think it would clearly have been the flash crash could have been possibly avoided, or it could have been, at least the effects could have been mitigated, if the algorithm had been coded in a more sophisticated way by looking, for example, at also the price at which they were trading, or by having a longer execution schedule. I think probably, at least you would hope, market participants have learned from that, investment firms have learned from that, and don't use this very simple form of POV algorithm anymore. But there might be, of course, other situations where also a more sophisticated algorithm interacts in unintended ways or unanticipated ways with the algorithms of other market players, and that can then again lead to pressure on one side of the order book.
Can I add a comment to this question?
Yes, of course.
Because one thing that we could not ignore is that there is criminal behavior. So the reason why sometimes intermediaries do not adjust their algorithms, and it's clear from the legal charges of the SEC. The SEC clearly describes situation in which, for example, the trader makes a mistake, like having an algorithm that doesn't really work. Then the mistake may generate a profit for him, and if there is no legal action, then you make money. No, free, because otherwise, if there is no profit, it's on the client.
Yeah.
If there is legal action, then it was a mistake, and hard to have responsibility for that.
Yeah.
So I mean, your question, Jeremy, is Yeah, we were talking about market participant learnings, but sometimes there are market participants, they do not care about flash crashes. They care about making as much money as they can, and sometimes with criminal behavior.
Indeed, I agree. I think like one of the points in follow-up on that is exactly that. Like perhaps people are kind of saying, oh, HFTs are the problem in those markets. Maybe we should actually limit less sophisticated participants from accessing the market directly, having trading only with intermediaries, and then HFTs who actually have the ability to who have the scale. Then we can say, okay, but if you make a mistake, then you're 100% responsible because you're big enough to look after your algos. And then you're like, okay, you can't say I'm small or whatever, I can't deal with it. You're big enough to deal with your own algos.
I think in principle that is the position, right? If you make a mistake in the sense of you don't have the appropriate safeguards programmed into your algorithm, or you simply you simply have the algorithm executed incorrectly, or your algorithm is programmed incorrectly, then you would be in violation of I think in most cases you would be in violation of the existing regulatory requirements. That's a bit the case of Merrill Lynch that I referred to before, right? They were held liable because not in that case, not because the algorithms were coded incorrectly, but because they didn't have sufficient safeguards in place, sufficient, for example, limits in terms of price movements, in terms of order volume, etc. And that was exactly the same with Waddell and Reed in the 2010 incident. So that's we have these regulatory consequences already on the books. If you have more malign behavior, so you have intentional misconduct in order to exploit market disruptions, then you would likely fall within the prohibition of market manipulation, and you would again, of course, be held liable. And I haven't talked about that here, but there are a set of additional requirements that are imposed on investment firms in order to facilitate the identification of potential incidents of market manipulation. So I think there the regulator is actually well aware of the problems and has taken some, I think, reasonably effective steps. But what I think is more problematic is the case where there is no misconduct, there is no purportedly incorrect, or no, at least at ex ante incorrect coding of the algorithm, but we have unexpected interaction effects that trigger market disruptions.
Yes, thank you. I guess that in law you have enough tradition in being able to distinguish between, genuine mistakes, negligence, and the criminal behavior. It's like when you drive a car, you can make a genuine driving mistake. You can be negligent because you are handling your mobile phone, or you can drive in the crowd because you want to kill, because you are a terrorist. I mean, I think this is an established distinction of scenarios in law, which probably applies also here. By the way, Jeremy is a PhD student of Tommaso, and may be connected from Milan today, so be closer to
London, actually London, but yes.
Thanks for being here in any case, and thanks for your questions.
So is anybody else going to ask a question before Roberto is going to ask comments?
I have this is Gerardo. Do I have the possibility to ask a quick question to the speaker?
Yes, go ahead.
Hi. First of all, very interesting talk. I really enjoyed it. I think you made several good points that are good food for thought, and you will make us talk long after your seminar is over. But I had a question in relation to testing the algorithms that you raised toward the beginning of the conversation. You were wondering whether this testing should have done, for example, inside the authorities and not instead within each institution that may be asked to pursue this testing. I remember in 2018, there have been published a supervisory statement from the PRA in the Bank of England, in which it was explained as, this was published in June 2018, if you haven't seen this statement. But by the way, this short document was explaining the fact that PRA was expecting these algorithms to be tested prior to deployment and to create a documentation that, by the way, authorities, I believe, have access because they needed to check that institutions comply with these requirements. So authorities should be aware about what are the main algorithms that are used in order to make trades in the financial market. So they are not completely blind. They can make any sort of a request or checks if they have doubts on what could happen after employing them. But my question now more in detail is, what do you think about the interaction instead between algorithms? Since you are making such a good case for having the authority lens on this problem, and you're submitting the discussion so well, will you now include also the fact that the interaction between algorithms should be tested as well? Because sometimes an institution could not even know that the two or more algorithms that the per se stand alone, they do not create any significant effect on the market, but maybe together may become an explosion mixed of algorithms that instead are detrimental. Do you think this is something that we should look at, or you think that that's not the case?
Yeah,
your opinion.
Think, yeah, thanks, Gerardo. I think that would be that's a crucial point, and I think it would be very important to find some way to facilitate the testing of algorithms in interacting. So in a market environment that is reasonably realistic. I think it's quite clear that in many cases interaction effects create the harmful consequence and create market disruption. And the Waddell and Reed case is a particularly striking example, because even though the algorithm, as we said, the POV algorithm is simplistic and it doesn't contain what should have been there in terms of safeguards and maybe order limits or price limits, it doesn't contain anything of the sort. Still, the algorithm itself, there's nothing wrong with that. It doesn't create any harmful feedback effects or so, even though it's recursively programmed. And it can be, you could argue that the price jump that it triggers is simply a reaction to a change in fundamentals, namely that Waddell and Reed decide to divest of a large position, and that needs to be priced in, of course, swiftly. So there's nothing wrong, I think, with that algorithm as such. The problems start when we look at the interaction between the algorithm and HFTs or other market participants. And in order to test that before the fact, so before any harmful market events occur, it's necessary to simulate a market environment that brings in the algorithms that interact potentially then also in the live market. And what the question I'm struggling with is, how can that be achieved, and who is best placed to achieve that? We have already, of course, simulated market environments provided for by the London Stock Exchange, for example, or other stock exchanges, where algorithms can be tested on the basis of actual past market data. And the London Stock Exchange has programmed a number of scenarios in order to facilitate also some sort of stress testing. What I'm interested in here is whether that gives us already an effective way to test and potentially identify harmful interaction effects. And I think there's relatively little research on that question. But I would think that in general, a regulator should try to facilitate that as much as possible.
Thank you.
Thank you very much.
Thanks.
Next question.
I also have a quick question. Maybe it's one of Roberto. Maybe Roberto will ask the same question, but so first of all, thank you, Carsten, for your talk. It was super interesting, very, very interesting. And so in the latest version of V-Shapes that Roberto and I have, and that you will see, we will send it to you for sure in the next few days. So we analyzed the same event that you mentioned in the beginning of your presentation. So the fact that Merrill Lynch was charged by the SEC. And in that legal charges, basically the Securities and Exchange Commission identified 15 mini flash crashes, so 15 events. And we applied our v-statistic to those 15 events, and we were able to identify them as well. But we found some others, so some more events. So we were wondering, do you know, maybe do you have an idea of how the Securities and Exchange Commission identified those 15 particular events? What's the algorithm they used? Why those?
Yeah, I don't know how precisely they identified them. I don't know what the methodology is that they used. I only read the publication of the SEC, the statement where they published the fines that they imposed on Merrill Lynch and other investment firms. I presumed that they simply looked at price jumps, but there might be a more sophisticated methodology. It would be useful to look into that. If we think of circuit breakers in the United States, they certainly just look at price jumps. So that's the normal way how the regulatory environment in the United States and also in Europe identifies instances of significant market movement or market turbulence. And that, as I said, is I think not a sufficiently sophisticated way to make the case for regulatory intervention. The SEC had it a bit easier in the Merrill Lynch case. They didn't need to identify actual market inefficiencies. So they didn't need to identify, they didn't need to make the case that these mini flash crashes were expressions of transitory volatility. So truly of market disruptions, because the fine was based on non-compliance with certain internal control requirements on the part of Merrill Lynch. So Merrill Lynch didn't provide in their internal testing and monitoring environment sufficiently stringent controls in the view of the SEC. So that was an easier case in that sense for the SEC to substantiate that penalties should be imposed.
Yeah, thanks.
Okay, so if there are no other questions by the rest of the audience, I would give the word to Roberto because I'm keen to hear his.
Yeah, but I'm not speaking much because it's late, and of course I thank. Well, first of all, I thank Guido and people organizing this here because it was a great venue, and maybe it can. I mean, I read your paper, Carsten, and to me it's a gold mine of ideas because it's nice to jump in an interdisciplinary field with a different language. But the main difficulty is to find references which people in law, they put in footnotes why we put at the end. But apart from that, I see that it was, no, I mean, for you entering I understand the effort in entering the financial literature that you did and phrasing this in the regulatory framework. I think it's a great read and for ideas or for cross ideas. But let me stick to what you did, because one thing that I liked was the way you use the word identify. I'm interested in practical and philosophical questions. So the way you use the word identify, I'm sure it's not, you didn't mean it the same way I, as an econometrician, use it, but actually it's the same way. That is, finding something that is true up to a certain confidence set. I'm wondering whether this is what can be used in court or not. The other thing that I wanted to comment is that I think that your program, your goal is too ambitious, right? You want to look at a regulatory definition of crime starting from algorithms, and sometimes even from the way algorithms from different participants interact. That's, I think, too complex. It looks like a cryptographic way of thinking, right? It's too difficult to unveil, I think. That's my opinion. But we can look at what happens in the market. Reverse engineer the problem. That's what the SEC did in the Merrill Lynch case that we also studied in the recent days. And the way the SEC followed was, wait, we have a number of events. Here there are 15, but there are more. So basically the way in which a regulator, it should be something statistical, right? Because the way the SEC followed was, there are many events. So what do you want to do? And indeed, they didn't go to court. The Merrill Lynch accepted to play without any
Roberto, we lost you.
compliance, to pay without any compliance. There was kind of game theory approach there. But I mean, I think we cannot disentangle the regulatory aspect from the statistical aspect. And I want to hear you more about this. What would a judge in court do? And the third, final, me and Maria, as Maria said, we find many events. So coming to your question, this finding of the V can be used to investigate ex post. The T, the left side, can be used for circuit breaking. It's a huge field because, of course, just to give you numbers, with the V, we find 30 events per year in the US index. If you use a volumetric or a jump metric, you find thousands. So it's basically not doable. Mm.
Yes, Roberto, we keep losing you, but maybe your question has been asked until the end. And Carsten can start his answer.
Yeah, would be good if he could hear it, but hopefully he'll be back in a moment. Yeah, about the first point, identification. I don't use it in a technical sense in which you would use it. That's true. But in some cases, I think also in regulation, it is important to I think use identification in the technical sense, in the statistical sense, or in the sense in which you use in economics and econometrics. And that is when regulation relies on, in order to impose liability, for example, or to impose a fine, where regulation relies on the establishment of a certain causal link. Then I think you would need to use statistical methods in order to show that a particular action actually caused a particular market disruption. And so I think in the context of liability, this will be important depending on how the liability provision is phrased. In the context of circuit breakers, I think it is also important if the regulatory goal is to distinguish between fundamental and transitory volatility. So if you need to identify, and now identifying, I am using that in the sense of econometrics, if you need to identify instances of transitory volatility versus fundamental volatility. So I'm using it probably loosely in my paper. I don't remember where exactly I used the word identification, but in some contexts, I think a regulator, or we as lawyers, to rely on a proper identification strategy from economics or econometrics. The second point about reverse engineering, yes, so I think in many cases the SEC has an easier job than what I maybe want to push regulators to do in my paper, because it looks, as in the Merrill Lynch case, it looks at instances of potential market disruption, or at least of market turbulence, of high volatility. And then it looks more closely and it investigates whether there have been violations of the applicable regulatory framework. And in the case of Merrill Lynch, they found such violations. And as I said before, in answer to your question, Maria, the actual reason for the liability was not that there was a market, that there was a flash crash, but that the SEC came to the opinion that the necessary safeguards did not exist within Merrill Lynch. The internal testing and control environment didn't fully implement the legal requirements. And so liability, in a sense, would have arisen even if there had not been a single flash crash. But the fact that there were a number of flash crashes directed the SEC's attention to potential non-compliance by Merrill Lynch. In that sense, this is clearly reverse engineering, and that works well, I think, in order to enforce securities regulation, provided you have a vigorous regulatory authority, such as the SEC, that is also well staffed, well resourced, in order to monitor market events and then investigate more closely. And I'm a bit doubtful whether you have that necessarily always in the EU, in all European economies. But I don't think reverse engineering works when we think about the prevention of market disruptions through circuit breakers, for example. By definition, if you look at market events after the fact and then you reverse engineer, it's too late in order to prevent the market disruption. So for the calibration of circuit breakers, I think it is necessary to think more closely about these questions that I raise in the paper. And I think it is also important because I would think that circuit breakers, as currently calibrated, overreach. Since they react to any price jump, it's quite likely that they halt trading also in cases where it is not justified to halt trading and where the effects of the actual circuit breaker are harmful. Price discovery is delayed and markets actually become more inefficient because of circuit breakers. So I think we can't really get around that question. And the last point about the T statistic, yes, that's I would like to talk about that more with you and discuss in more detail, but maybe we can schedule a separate call and discuss in more detail how the T statistic and the V statistic, how they can be used in order potentially to calibrate circuit breakers better in the real world.
And we certainly will, I guess.
Yeah, I would hope so. I would hope so. That would be great.
We need to close in a few minutes because I have another meeting. I have two short questions or observations. So we have already assessed that a rise in volatility itself is not bad. It's there also for the efficient and semi-efficient market. The question is to distinguish between, let's say, the fundamental and the transient volatility. And you suggested to use the square root law. I wonder whether the leverage effect, which is an established stylized fact where there is a negative correlation between returns and volatilities, could also be used with a similar purpose.
Yes, thank you. Yes, I will look into that. I don't think the square root law it helps us really that much. So that's certainly not the end of the story. I just mentioned it because I think it gives a certain intuition of what is important in trying to identify transitory volatility, or what could work as a proxy for transitory volatility. But the square root law, I think only gives us an indication of what clearly is a case of transitory volatility where it is justified to halt trading or to have some form of market intervention. And that is when the impact function becomes convex. So that as such doesn't really tell us how the regulatory intervention should be shaped. And I mentioned a number of possible proxies on the previous slide, but I think there needs to be more work in general in order to understand better what leads to how is liquidity influenced in automated markets and what leads to a dry up of liquidity. So I look at that leverage effect as well, and in general I think need to think more about how this can be conceptualized better.
And then a very telegraphic question. If you go back to the POV percentage of volume algorithm with the slide, there is the final formula, the second, stop there. So the second equation with sides after t intervals, of course, assumes that this volume remains constant at V0 if nothing else changes, but if you add an order of percentage P, which is 9%, so it's sizable, you would have a 1 plus P to the power T component, and then you make a simplification that you neglect higher powers of P. So probably this equal is an approximation.
I don't think so, but we can talk about that more as well. I thought it's not an approximation because you have the higher, you add up all of the higher powers for each time period. Mm-hmm. You add them up, and then for each period the additional contribution, the additional size contribution, because of a higher volume becomes increasingly smaller. So I thought that was an equality actually, but mathematics is not my main field, as you know. Well, so it would be great if we could go through that in more detail.
And in this case, it would probably just the question whether it's an approximation or not.
Yeah. Yeah. Yeah, and the main message wouldn't change, I think. That's right, but the algebra should be correct. I can send you or actually you saw it in. I think you have the paper where the full calculation is. But I'd be happy to talk about that more.
So unless there is a very last telegraphic observation, I would thank you everybody for this exceptionally deep discussion, which is not common. So typically discussions fade out after 2 or 3 questions, which also shows the interest in this topic, which probably could be called reg tech. There is a lot of emphasis in fintech, but there is also technology entering regulation. It has been there for years. And so very last opportunity for somebody here. Otherwise, I thank everybody and see you in the future again.
Yeah, thanks very much, Guido. Thanks very much to all participants and especially to Roberto and Maria again. And I'm looking forward to continuing the conversation. Thanks a lot.
Bye. Thanks to Carsten and thanks to Guido for this cycle of seminars.
Thank you. Bye for now.
Bye.
Okay, bye-bye. Thank you. Thanks, everybody.